We know rentals have been skyrocketing over the last couple of years, but the latest rental report from My Housing Market suggests that even though vacancy rates are still falling, rents are steady or in fact dropping in some places. What's going on? We discussed that in this week's Property Insider chat with Dr. Andrew Wilson. We also discussed the latest construction cost index, giving an indication of how building costs are going to keep rising, and also the auction clearance results, which give us an in-depth, in-time indication of what's happening in our markets. If you want to keep up to date with our housing and real estate markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. As we transition out of winter, the rental markets around Australia are showing some intriguing trends. Despite tightening vacancy rates around our capital cities, we're seeing a general easing in rental prices. Is this now going to start offering some reprieve for tenants? To understand what's really going on, I'm looking forward to my weekly Property Insider chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, and I'd like to unpack the latest My Housing Market rental report. Hi, Andrew.
Yes, good day, Michael. And we've had this lengthy period, I guess, with the descriptor of the rental crisis and amongst other, reasonably severe, name tags for what's been happening, and probably completely appropriate because we've had an unprecedented period of rental property shortages. And of course, that's pushed up rents through the roof. We've just started to see some easing in what have been remarkably low vacancy rates over the last few months. And I think that, there are two factors working here, Michael. The first is the winter period, where we do get less demand for all property, not just rental properties, but there is less demand. So that acted to push up vacancy rates. But of course, we're now at the end of winter, so we have started to see, and we'll look at the figures in a minute, some, readjusting of those higher vacancy rates. I do think also that rents, as we could probably appreciate, don't respond straight away to changes in vacancy rates. It probably takes a month or two for those changes in vacancy rates to translate into rental changes. So we've seen a little bit of a disparity between what we would expect changes in vacancy rates and changes in rentals. So some seasonal effects over the last few months, which is not surprising. But the other factor, I think, which is acting now to reduce demand, is that over a lengthy period of time with these crazy low vacancy rates and skyrocketing rents, people make decisions. They're locked out of the rental market, so they start making decisions in regard to their accommodation choices, and that may mean they stay at home longer, they stay in their existing rental accommodation longer. Perhaps they consider sharing with siblings or friends. Maybe they start looking at a different type of accommodation, a unit rather than a house, or a larger house rather than a smaller house. Maybe they start looking at where they're going to rent further out in the capital cities, or even into regional centres. And I think this is, completely explainable when we do have these lengthy periods of what is a clear unprecedented undersupply of rental accommodation in this country, and of course one the government's quite anxious about, and many governments are anxious about, that have similar economic profiles that we have. And Canada's one of those, similar to Australia, has recognised the significant political issues involved with a shortage of housing. They have announced a sharp reduction in international students. And we've done the same thing here, Michael. We're going to reduce significantly the number of international students coming in. And this is clearly a strategy to hopefully put downward pressure on rentals. With elections coming up both in Australia and Canada, it's no big surprise. So shall we have a look at the figures for August, the latest figures?
Sure.
And
before we do, maybe it's just worth remembering, Andrew, that of course, while international students do use accommodation here, they don't bring their houses with them. They tend to rent, consolidate in various locations around the educational institutions, and they are our third biggest export
Yes.
industry after mining and agriculture. And if we don't have the international students subsidising our universities, it's going to be interesting to see how the universities are going to keep doing the research and keep educating locals at a reduced price. Stopping students isn't really a housing policy, is it? But it's a quick fix.
Exactly. And that's it. It's a short-term knee-jerk reaction. So that it really is a political sort of short-term view of the world because we do have an election coming up next year. We know that there are very significant consequences in terms of political outcomes when we have a populace that is highly concerned about high rents and high prices. And we're not alone here. It's, you know, something that a number of other similar advanced economies are suffering in Western Europe, the UK, the US, Canada. But as you said, it's are we throwing the baby out with the bathwater by reducing what's a very significant income source for our country? It is a it's a high job creation industry, and universities, you know, use the fees they get from international students really to keep themselves running. And it's also, as you mentioned, research, you know, that is supported by universities that is paid for with those international fees. And, you know, the other point is that our big export earners, you mentioned agriculture and resources or mining resources, we're having some issues with our mining resource income, which our latest GDP numbers reveal. Of course, you know, we're struggling to find as much of the demand for coal as we have, being one of the world's biggest coal producers. Now we're moving into the, you know, renewable energy environment, which is basically mandated through most advanced economies, and that's put a cap on our coal exports. And of course, we've seen lower prices for iron ore as well. So it's like just when it, you know, it doesn't rain, it pours. Just when we sort of needed an offset for, you know, the decline in international students announced by the government, or the cut in international students, we're also seeing a decline in our income, and our GDP didn't really grow by that much over the last annualized over the last quarter, Michael. So you know, it's not a great response, but I think it's all the government can do, to be quite honest, because we're certainly not building anywhere near what we need to build. A few more houses coming through now, but apartments are still trundling along well below their long-term averages. But we are starting to see more investors coming into the market if we look at that home loan data. So maybe more investment properties coming in because investors are attracted by those high rents and capital growth. But nonetheless, I don't think these are going to be certainly short to medium term solutions to what's an ongoing, you know, really, and I don't like hysterical language, but you know, it is still a bit of a rental crisis, notwithstanding coming out of the winter period where there was a little bit less demand.
Well, as you say, over winter, there is a seasonality. People tend not to look for rental accommodation as much. So let's dive into your figures for August. Sure, we're in September, but these are the latest figures that have just come out.
Well, we saw, as I mentioned, we've seen a general trend over the past few months, Michael, of vacancy rates actually easing. We had a you know, month after month of some of the most remarkably low vacancy rates for both houses and units. They're well below 1%. And of course, you know, we use 2% as a bit of a benchmark. 2 to 3% vacancy rate usually equates to a sort of a balanced position in terms of rental growth. So, you know, rents rise typically when vacancy rates fall below 2%, and they start to fall or stabilise once they are at 2 or above 2%. But we've seen vacancy rates well below 1% for a long period of time, Michael, which was just crazy stuff, unprecedented stuff in most, if not all, capital cities. So we did see some easing. As I said, perhaps some, you know, social change happening there, people being locked out of the rental market rather than new supply coming through, just some shifts in demand. And we saw that continuing over winter with that trend to higher vacancy rates. There is a bit of a gap between changes in vacancy rates and changes in rents. They don't necessarily follow each other from month to month, and I think that's why we saw with this month, although we did see an adjustment downwards with vacancy rates generally, so vacancy rates fell, which I think was just moving out of the winter period. It was about more demand. rather than more supply or less supply coming through, matching that. And rents, however, were a little bit lower over the month, even though vacancy rates were higher, were lower, sorry. We would expect that to follow that, but just because of that lag. But I still think the outlook remains certainly challenging for tenants and positive for landlords. So the actual data, we saw Sydney and Melbourne house rents down by 2.4% and 1.6% respectively over August, and yet vacancy rates were lower in Sydney at 1.3% and steady at Melbourne at lower at 1.2% than Sydney. All the vacancy rates are still really well and truly in favour of landlords and a nightmare for tenants, just above 1% now. So we're not seeing the 0 point percents, we're now seeing the 1 point percents, but they're still very, very low, with only Canberra looking reasonably balanced at 1.9%, but that's still a result that you'd consider to be putting upward pressure on rent. So for houses, generally some easing in rents, which I think follows those higher vacancy rates that we had over June and July, but vacancy rates starting to readjust downwards everywhere except Melbourne and Brisbane that were flat. But they still, Michael, remain very, very much at near record lows and in favour of landlords and higher rents. And certainly there's plenty of competition for rental properties out there for houses. Units, a similar story, although we saw Sydney units up by 0.7%, back up to that record high, $750 a week. And vacancy rates are higher for units generally, in the big capitals anyway, but still quite low there in Adelaide and Perth, which saw some marginal easing in rental growth. But when we look at the annual figures for units, they're still well ahead of where they were a year ago. And similar to houses, we did see vacancy rates falling for units over August, although up slightly in Melbourne and Sydney, up in Sydney and Brisbane, and steady in Melbourne. So even though the Melbourne vacancy rate is looking a little better there, and I think a lot of that is the student market coming into to some of those suburbs that are proximate to the university sector. Still, it would overall, even though it's a slightly better position for tenants than landlords, still very much a landlord's market, I think, going forward. And as I said, I think that the long-term position still remains one of clear undersupply of rental properties in this country, particularly in our capital cities.
Well, clearly we're not building enough accommodation, and sure, we may not have as many students for a year or two, but there's all the other migrants coming in.
That's right.
And one of the things that's holding up the construction of new, particularly apartments, is just the cost of getting them out of the ground. Now, I know my housing market keeps a regular track on building costs, and while they've skyrocketed over a couple of years, which created its own issue in the construction industry, what's the latest figures been showing about construction costs, Andrew?
Well, we've certainly seen an improvement, as would have been expected, in annual costs. And this, of course, is a big input into inflation, Michael. What the ABS uses as their measure for inflation in the housing sector, they use rents, and that's not asking rents, because that's what we look at here, is asking rents for new rental properties, or for newly listed rental properties. They look at the total rental market. But as well as rents, they look at housing costs, and their housing costs they define as being the cost to build a new house. So this index is very important, and that was one of the reasons a significant reason we saw that breakout in inflation in Australia, was that we had skyrocketing house building costs following the previous government's home builder policy, which was a stimulus package through the COVID period. It brought forward a lot of demand for houses. Of course, we didn't have the building materials or the labour to match that demand, so house building costs increased by extraordinary levels, unprecedented levels, and of course that worked its way into the inflation rate, which of course worked its way into higher interest rates. So it's important to keep an eye on what's happening with house building costs. And even though we haven't seen the growth that we saw through that peak period of skyrocketing house building costs, and nonetheless, we're still at high levels. And even though we're not growing annually at the same rate, if we look back to where we were prior to the house building or the home builder allowance, we're well ahead of what we paid to build for what it cost to build a house at that pre-COVID period, and that means it costs a lot more now to build a house than it used to, and that, as you said, Michael, is another constraint to our undersupplied housing market. But if we look at the annual growth levels, they did peak back in the middle of 2022 at a quite remarkable 22.7% annual increase in house building costs. It has obviously moved downwards since then, but we're still tracking at the moment at 3%, which is the same period as the previous month, 3% growth rate, which, although a lot better than where we were as prices were skyrocketing, it's still a significant increase compared to what was typically lower results than that annually for house building costs prior to COVID. So a lot better in terms of our monthly annual growth rates, but certainly still putting upward pressure on the inflation rate, and that means, you know, still something to be looked at in terms of the prospects for interest rates.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Well, each week we talk about the auction results as well, because all these are big picture figures. Auction results tell us what happened last weekend, how buyers and sellers are feeling. It's a good in-time indicator of the markets. We've now moved through the quieter winter market into spring season. That's also brought more listings, more properties for sale onto the auction market. What's happened with the depth of the market? How have people been responding to all these extra listings?
Well, it's been you mentioned the quieter winter period, which it was in a sense, but it was a very strong winter. As winters go, particularly for listings, Michael, and really clearance rates stood up. So the auction markets have been remarkably resilient this year. And of course, they've been defined by a big leap in listing numbers from the beginning of the year. And that's what we see in this part of the cycle. Last year, we saw a revival in buyers who were attracted into the market following the downturn of 2022. Of course, there were good value opportunities. So the market turned and grew. This year, it's all been about the sellers coming back into the market. Of course, they have more skin in the game, so it takes them a little longer to adjust to a revival in the market. But that's what we typically see in the sort of the cyclical outcomes of housing market activity. And that's sort of continued now. And this is when we really expect to see a surge in listings, the first, or as we move through September. And we've seen that particularly at the weekend, where we saw a remarkable surge in listings, particularly in Melbourne and Sydney, which was a big test for buyer depth, obviously. But clearance rates were a little bit lower, perhaps reflecting those higher listing numbers, but still thereabouts where they have been. But it was a little bit mixed in some of the results. But next weekend, Michael, is the pre-grand finals auction Super Saturday. So it's our second Super Saturday of the year. So we will likely see a significant increase again in listing numbers. And of course, that's going to be another big test for the depth of our early spring buyers. So looking at the numbers, over 900 auctions in Sydney, well ahead of the year before. Sydney clearance rate under 70%, first time in a while. But nonetheless, considering the surge in listings is quite a reasonable result there for sellers. We look back a year, the clearance rates are not that dissimilar to where they were a year ago now, Michael. In Sydney, 72% a year ago, but listing numbers well ahead, as we've been sort of describing just about every weekend this year in most of our markets, 811. Melbourne, a big weekend of auctions in Melbourne, and it'll be even bigger by certainly hundreds next weekend, likely 1,129 auctions, up from 949. Again, clearance rates down a little bit from the same weekend, from the previous weekend. Again, perhaps a response to that surge in listings, but listings again well ahead of a year ago. And the clearance rate, again, similar to Sydney, not that dissimilar to where it was a year ago, Michael. So the markets are sort of now consolidating buyer and seller activity to around about the same level as a year ago. Brisbane listing numbers down. Again, it had a slightly weaker or a higher clearance rate, but certainly a weaker clearance rate for Brisbane, where we do expect to see 50% plus. But again, auction numbers higher than a year ago, but the clearance rate well below where it was a year ago in Brisbane, because Brisbane was in the middle of that very strong period. We've never seen clearance rates that high in Brisbane as we did a year ago, and that was just a reflection of that boom time market. Adelaide down also a little bit with higher listing numbers, and its clearance rate a little bit lower, but not too dissimilar to a year ago. And Canberra bounced back after what was a strangely weak weekend. The previous weekend, we didn't get a lot of results coming through, so I think it was a matter of the measurement process rather than the market activity levels. But a better result there for Canberra with 56% and around about where it was a year ago. So when we're looking at the September trends so far, of course, that's over the first 2 weekends, Michael. Sydney's still around about where it's been for most of the year, above 70%. Melbourne's, is really continuing to track higher than it has for around about 6 months. So we await I guess, a revival in the higher price sectors of the Melbourne market, which has been sort of holding it back. But no real sign of that yet with our regional results, Michael, out of Melbourne. It's still very much the outer eastern suburbs and the south eastern suburbs and the western suburbs that are holding the Melbourne market holding that Melbourne market in a positive sense. Brisbane, yes, strange start to the year for Brisbane with clearance rates under 50%. We'll keep our eye on that. Adelaide's still tracking above 70%, well above 70%, which is Australia's strongest capital city market. And Canberra just on the back of what was a very low result weekend before last, struggling to find where it was, but I think we'll see a revival in that Canberra market. It'll back up to those near 60% levels or just above 60% levels that we saw over August generally. So those results are available on my LinkedIn channel, Doc Andrew Wilson at LinkedIn, Saturdays at around about 6:30 p.m. And Michael publishes the full regional results from the capital cities. Well, they're from Melbourne and Sydney, the full regional results, plus the top 10 sales out of each of the capital cities on Sundays. And you can also get that through my LinkedIn account. So it's been an interesting week for property, of course, Michael. We're looking forward in the big picture to see if the US cut their interest rates. I think they're meeting this week or next week. It's certainly been promoted as being an absolute certainty that they're going to drop their interest rates. So let's hope the media don't get it wrong again for their point of view. But there was some mixed news out of it for inflation for the US, where it saw its underlying inflation rate picking up a little bit. So it's not a done deal, but we'll see what happens. But I don't think there's any implications there for Australia, because Australia's interest rate is still well below the US rate. And our inflation rate is well above it. But that's all to come, and we'll discuss that when that data is coming through. But look, some better news for tenants perhaps at the margin, some better news. But overall, I think just we can still say it's bad news overall still for the rental market for tenants.
And it's unlikely to change in the near term.
Yeah.
It's interesting that America's having its interest rate decision with the Fed, and we don't have as many discussions about that now, Andrew, because the Reserve Bank doesn't meet every month like it used to. It's only 8 times a year. So it'll be interesting to see what Michelle Bullock comes up with when she meets in a bit later this time round.
And I think it'll be interesting to see some of the questions from the media, given that she's had a bit of a profile over the last couple of weeks with some of her comments. And I'm sure she'll get a few questions in regard to that, particularly her comments regarding the housing market, which took a lot of people by surprise.
Well, thanks for giving us an insight into the rental markets and the house building costs. Catch up with you again real soon. Thank you.
Thanks, Michael.